So, you've spent months hunting for that absolute perfect home, you finally had your offer accepted, and you got that golden pre-approved stamp from your lender. You might think the hard part is over, right? Well, not exactly. The time between getting your offer accepted and actually getting those keys in your hand is, without a doubt, one of the most critical financial periods of your entire life. Literally one wrong move, and the whole deal can just fall apart. Okay, let's dive into this explainer and explore the absolute do's and don'ts of securing your home loan. We're going to break down the critical financial actions you absolutely must avoid during the mortgage process.
I mean, it sounds ridiculous, doesn't it? Could buying a couch really ruin your mortgage? Picture this. You've got the house, it has this massive, beautiful living room, and you see an amazing deal on a new sectional sofa. You decide to just finance it on a new store credit card. Seems perfectly harmless, right? Wrong. In the eyes of a mortgage lender, that simple furniture purchase might actually be the exact thing that prevents you from ever moving that couch into the house. Today we're looking at exactly why that is, and how seemingly normal, everyday purchases act as hidden traps.
Think of today's explainer as your survival map. We'll be navigating the mortgage approval maze, highlighting the specific credit traps you need to avoid, pointing out cash and employment red flags, and wrapping up with concrete steps for mortgage success.
All right, let's jump right into part 1, the mortgage approval maze.
Here's probably the biggest misconception in real estate. People think that once a lender says yes, it's a done deal. In reality, your approval is highly conditional. It's a very delicate path. Until you have signed the absolute final papers and those keys are physically in your hand, lenders are constantly watching for any sign of financial instability. They are literally checking your financial pulse right up into the closing table to make sure nothing has changed. Which brings us nicely to our second section, credit traps to avoid. Welcome to the financial minefield. As you can see here, certain actions trigger immediate alarms for an underwriter. If you mess with your credit, like opening new cards or co-signing a loan for a buddy, it instantly lowers your score and hurts your debt-to-income ratio. If you mess with your income by changing jobs, it screams instability to the bank. And if you move cash around with undocumented deposits, boom, you've just raised major fraud concerns. Let's look under the hood for a second, because understanding the mechanics here is absolutely crucial. When you try to open a new line of credit, two bad things happen. First, the creditor does a hard inquiry on your credit report. Just the simple act of them checking your credit temporarily lowers your score. Second, if you actually take on that new debt, say by buying a car, it negatively impacts your debt-to-income ratio, or DTI. This ratio is just how much money you owe every month versus how much you make. Lenders have super strict caps on this. If that new car payment pushes your DTI even a fraction over their limit, your mortgage is denied. Period. No way around it. You see, it's all about perspective. And this is exactly where buyers get tripped up. As a buyer, you see yourself doing totally normal things. You're buying furniture, so your new house isn't empty. Or maybe you're doing a really good deed by co-signing a student loan for a relative. But listen, lenders don't see a cozy living room setup or a generous uncle. They see you taking on new, binding debt obligations. Even if you co-sign a loan and someone else is making the payments, the lender assumes you might get stuck with the bill. It spikes your debt ratio and makes qualifying significantly harder. Now, while you're busy avoiding taking on new debt, you absolutely cannot drop the ball on your existing bills. Missing even a single existing payment right now is catastrophic. 1, it severely damages your credit score almost overnight. 2, that score drop makes securing the final mortgage incredibly difficult. And 3, even if the lender decides they're still going to give you the loan, that missed payment means they'll likely penalize you with a less favorable interest rate and might could cost you tens of thousands of dollars over the life of your mortgage. Okay, let's pivot to our third section, cash and employment red flags. Imagine this scenario. You are halfway through closing on your dream home, and you get an incredible job offer. Better title, maybe a nice little pay bump. You'd think a lender would be thrilled, right? Actually, it terrifies them. A mortgage approval is heavily based on a predictable historical employment record. Changing your job right now threatens your income stability in the eyes of the underwriter. They need to know with absolute certainty that you can repay the mortgage. A new job often comes with probationary periods and a totally unproven track record, so don't make the leap until after you have those keys. Now let's talk about your bank accounts. Suddenly deciding to move $10,000 from some random account into your checking without a paper trail, that is a massive red flag. Lenders track the source of your funds very, very meticulously. Making large deposits or withdrawals without thorough documentation raises major concerns. To the underwriter, unexplained cash suddenly appearing out of thin air might indicate unstable finances, hidden loans you haven't disclosed, or even fraud. Every single dollar needs a verifiable origin story.
All right, let's get out of the minefield. Moving on to part 4, steps for mortgage success.
So, what should you actually do? Here is your step-by-step playbook to keep the underwriter happy. Step 1, keep your current accounts incredibly stable. No sudden moves, no big changes. Step 2, save every piece of documentation. Have your recent pay stubs and bank statements ready to go to provide a crystal clear picture of your situation. Step 3, stay in extremely close contact with your loan team. If they request a document, don't wait 3 days, respond right away. And Step 4, continue saving for your closing costs. By avoiding large purchases, you ensure you've got the cash on hand when it's time to sign. Honestly, it really all boils down to this single concept. Stable finances equal a successful closing. Your primary goal during this waiting period is to be the most boring financial version of yourself possible. The discipline you show right now directly increases your chances of a smooth, successful home buying experience. So, I want to leave you with this final question to consider before you take another step in your home buying journey. Is your financial paper trail truly ready for the underwriter's microscope? Remember, it is not just about what you buy, but how every single financial move is viewed through the lender's lens. Keep things stable, keep things documented, and seriously, whatever you do, do not buy that new couch until the house is officially yours. Thanks for joining me on this explainer, and happy house hunting.